In this video, we will walk through the essentials of Denmark's value-added tax, or VAT, and highlight what businesses need to know to remain compliant while operating efficiently. Denmark has one of the highest standard VAT rates in the world, currently set at 25%, and it applies broadly to most goods and services supplied within the country. Unlike some other EU jurisdictions, Denmark does not operate with reduced VAT rates on categories such as food or transport. Instead, there is generally one standard rate alongside specific exemptions. For any business operating in or selling into Denmark, the starting point is understanding when you are required to register for VAT. Danish established businesses must typically register when their taxable turnover exceeds a relatively low threshold, so most active businesses will be in scope early on. Foreign businesses providing taxable supplies in Denmark may also need to register, even without a physical presence, depending on the nature of their activities and the place of supply rules under EU legislation. For example, if you are selling goods to Danish private consumers from another EU country and exceed the EU-wide distance selling threshold, you may need to register either in Denmark or use the one-stop shop scheme. Once registered, you will receive a CVR number, which is your central business registration number, and a VAT number, known in Danish as a momsnummer. These identifiers are fundamental for issuing compliant invoices, filing VAT returns, and interacting with the Danish tax agency, SKAT. From a practical standpoint, businesses must ensure that their invoices contain specific mandatory information, including the supplier's and customer's details, the VAT number, a unique invoice number, the date, a clear description of goods or services, the net amount, the VAT rate applied, and the VAT amount in Danish kroner. Failure to meet invoicing requirements can lead to challenges in deducting input VAT and may increase the risk of audit findings. One of the core concepts in the Danish VAT system, consistent with EU rules, is the right to deduct input VAT on costs directly related to your taxable business activities. When you purchase goods or services for use in your business, the VAT you pay to suppliers can generally be offset against the VAT you charge your customers, ensuring that VAT functions as a tax on final consumption rather than on your business. However, Denmark applies restrictions and special rules on certain expense categories, such as entertainment, passenger cars, and mixed-use costs, where input VAT may be partially or fully non-deductible. It is therefore essential to categorize expenses correctly and implement internal controls to separate fully deductible costs from those that are restricted. Filing obligations are another area where discipline is critical. VAT returns in Denmark are typically submitted monthly, quarterly, or half-yearly, depending on your turnover and business profile, with deadlines set by SKAT. Returns must be filed electronically through the Danish online tax portal, and payments must be made on time to avoid interest and penalties. Even if there is no activity in a given period, a nil return is required as long as the VAT registration remains active. In parallel, many businesses must submit SAFT-compatible digital records or be able to produce detailed transaction data if requested during an audit. Maintaining accurate, timely bookkeeping is therefore not just good practice, but an operational necessity. Special attention should be paid to cross-border transactions. For intra-EU business-to-business supplies of goods and certain services, the reverse charge mechanism often applies, meaning the customer accounts for VAT in their own country, and the Danish supplier may zero-rate the supply, provided strict documentation requirements are met, including valid VAT identification numbers and proof of transport. For imports from outside the EU, Danish import VAT is typically due at the border or via deferred accounting, while exports to customers outside the EU are usually zero-rated if sufficient export evidence is retained. Digital services add another layer of complexity. If you provide electronically supplied services, telecommunications, or broadcasting services to consumers in Denmark from another EU country or from outside the EU, you may be required to register for VAT in Denmark or use the EU or non-EU one-stop shop schemes to report and pay VAT where the consumer is located. For Danish-based providers selling digital services to consumers in other EU countries, the same principle applies in reverse. VAT is due where the customer resides, and the one-stop shop can greatly simplify compliance. Another important aspect is dealing with VAT-exempt sectors. Certain activities in Denmark, such as healthcare, education, some financial services, and certain cultural or sports services, can be exempt from VAT. While this may sound beneficial, VAT exemption also means there is generally no right to deduct input VAT on related costs, which can increase the effective tax burden on those organizations. Businesses operating in both taxable and exempt sectors must implement robust allocation methods to distinguish between costs that can and cannot be recovered, often using pro rata calculations overseen by SCAT. From a risk management perspective, Danish tax authorities adopt a fairly data-driven and risk-based approach to VAT audits, making consistency and transparency crucial. Common focus areas during audits include incorrect application of zero rating on exports, insufficient evidence for intra-EU supplies, improper use of the reverse charge mechanism, and overclaimed input VAT on restricted items. Establishing clear processes, documented VAT treatment for key transaction flows, and periodic internal reviews can significantly reduce the risk of disputes and retroactive assessments. For growing businesses, transactional changes such as mergers, acquisitions, restructurings, or entering the Danish market for the first time can trigger complex VAT consequences. These may involve transfer of a going concern rules, adjustments to historical input VAT, or new registration needs in Denmark and other EU states. Engaging early with advisors or SCAT can help clarify obligations and avoid unexpected costs. In summary, Denmark's VAT framework is straightforward in its single standard rate, but demanding in its expectations on documentation, timely reporting, and accurate classification of supplies and expenses. To operate confidently, businesses should ensure they are correctly registered, issue compliant invoices, understand their right to deduct input VAT, manage cross-border transactions in line with EU place of supply rules, and maintain rigorous records to support their VAT position. By embedding VAT considerations into everyday finance and operational processes, companies can minimize risk, avoid penalties, and focus on their core activities in the Danish market.